Hi, this is Steve Cologne with Cologne Villaplana. I'm here with my friend Kai Kullberg. Kai, introduce yourself to everyone.
Hey, my name's Kai. Work with Superior Mortgage. We have offices in Mount Kisco, Highland Mills, Melville, and Long Island. We're a mortgage broker. We work with about 20 to 30 different banks on the wholesale side. We also do commercial and private lending as well.
Well, thank you. So, Kai and I got together and we wanted to continue our, with my educational series and help, prospective buyers and borrowers out there. And one of the things that we were talking about is let's talk about seller's concessions. What are they and what they mean? So, Kai, can you explain to our audience what is a seller's concession, or how would you describe what a seller's concession is?
So, a seller's concession is essentially agreeing to purchase the home for a higher amount, up to 3% on the conventional side. Unless you're putting 10% down, then you can do up to 6%, or up to 6% on an FHA loan. You're essentially agreeing to purchase the home for a higher price in order to get a credit back at closing from the seller.
All right, so great. So, on a tax perspective, if your loan's higher, you're paying more interest, you're going to have a nice little tax write-off. You're also getting lent money so you can keep some of your reserves in your bank, or if you don't have money, obviously it helps you out, but you can keep some reserves for repairs and things that come along down the pike. So, the question that most people would have, if they still don't I still don't get what a seller's concession is, which I'll just reemphasize that now before I ask my question. So let's say you go an FHA loan and you're buying a $100,000 property. You're actually going to purchase it for $106,000. The seller's going to get $100,000. He's going to give you back $6,000 in a credit, and you're going to pay the seller's costs, which are very low on what that $6,000 would be. So Kai, going back to my question, why would a person choose not to do a seller's concession? It seems like it's the best thing since sliced bread.
Yep. So especially with rates being this low, it's very common that people do want to finance their closing costs and keep some money in their pocket. But while at the end of the day, if the home appraises, this is the purpose of why sellers might not be so fond of sellers' concessions. If the home appraises, the seller's still going to net the same amount of money in their pocket after closing. The reason why this is a little bit risky for the seller is because when you're getting a mortgage, the home needs to appraise. So it needs to meet that appraised value. If you're then asking to borrow money on $106,000, going off of Steve's example, the home needs to appraise for that amount. And if you didn't have the seller concession, the home would only need to appraise for $100,000. So the seller might want to choose the offer without the seller's concession, because if the home doesn't appraise, who knows if the buyer is going to be able to close on that home. They might need to finance the closing costs in order to have enough funds to close on the home. So while it is a very common thing for buyers to want to do, the sellers are a little bit reluctant, especially in this market, to accept those offers.
All right, so that explains a lot there. So I get personally, or now I get a lot of times where I have, and especially in this market right now, where it's 2021, we're in a seller's market. Even though interest rates are low, it's still a seller's market because the supply isn't out there. So sellers, like you said, don't want to necessarily risk staying in contract 2 months to find out that they can't sell, or they have to lower their price, and that's why they don't want to necessarily accept a seller's concession. I find, I'm pretty sure you're getting this too, a lot of people that are offering more than the purchase price in order to win a bidding war, or just let them get that deal. In that case, a lot of times, if there is a seller's concession, the agents work out a thing where it's almost like a voluntary seller's concession. Can you talk about your experience with that?
Yeah, I mean, even with this crazy market, people are already offering over asking price. Even without the seller's concession, we might run into appraisal issues right there. So, when you're really maxing out your financing, this can, it can, I wouldn't necessarily say an issue, but, it makes the sellers think of, what kind of offer is the best offer. And, when you're already over asking price and you have a seller's concession on top of that, the house now needs to appraise for that much higher. If it doesn't appraise, the buyer's at risk.
So Kai, being that you're a mortgage broker, would a lender's credit be an alternative, and can you explain what that is?
Yeah, so that's a perfect alternative for somebody who might want to be going into the home buying process with a seller's concession, who might be getting beat out on offers all the time. As we know, buyers agents are showing people dozens of homes before they can even get an accepted offer. Rather than a seller's concession, a pretty common solution to this is, take out that seller's concession, so the sellers aren't, as reluctant to accept your offer. And since rates are so good right now, you can actually take a lender credit, choose a slightly higher rate. Higher rates than the market rate right now are still incredibly good. So, you can get anywhere from 2 to 3% back towards closing costs and just a lender credit with still a phenomenally good rate.
All right, so some of those agents out there and some of those prospective clients that didn't know what a lender's credit was, I would hope you'd start speaking to your lender and start utilizing the potential of a lender's credit. Think a little outside the box. That may save them in that. Now, Kai, one of the things that we were talking about even before the video today, we were talking about how seller's concessions now, they're coming out in contracts as almost optional, meaning I'll accept your offer and I'll give you the seller's concession, but if it doesn't appraise, but appraises for what you actually offered, what the seller's supposed to net, that's what my client is expecting. So the contract will have something to that effect where they waive the seller's concession if it doesn't appraise. So can you explain how that might work differently with a conventional versus an FHA loan?
So the difference between an FHA loan and a conventional loan with the seller's concession is when you sign a conventional loan and go into contract, that contract holds pretty true to the verbiage in there. With an FHA loan, the client is a little bit more protected with something called the FHA mandatory clause, which Steve can touch on a little bit.
All right, so yeah, that's a good point. So, I explain to my clients a lot. Some sales attorneys don't really know their craft as well as I do, or some of my close colleagues. The mandatory clause basically states that if the property does not appraise, the seller agrees to give the buyer back their down payment if the buyer chooses not to proceed. So if you have a contract, and this is more for listing agents and sellers, if you have a contract that says, hey, the seller agrees to buy it for this price if it appraises and withgo the seller's concession or reduce the seller's concession, and that seller signs the amendatory clause after the fact, well, in New York, the last thing signed, like an amendment, like additional rider, this is like an amendment. This is basically taking that contract and voiding that language that you just negotiated. So you got to be very careful when accepting an FHA offer with a seller's concession with the language that, hey, we're not going to sign, we're going to forego the seller's concession if need be. Now, one protection possible, because it really comes down to the contract, is for that seller's attorney to withhold the addendum being signed. Now, Kai, what would that do to the process? How much would that extend, or would that hurt the process at all?
So usually all of our underwriter conditions are satisfied until the appraisal comes in. As you know, Steve, you've seen appraisals take quite a while just because of the volume that's going on. It's hard to find these appraisers. Sometimes it'll take 2 weeks to get the appraisal back. Sometimes it'll take 2 or 3 days. It all depends on what the appraisal management company, how backed up they are. And as most people know, we can't choose appraisers anymore after 2008. I just wanted to go back to what we were saying in the contract before. I like when the seller's concession is in the contract to start with, because we have a higher purchase price. And I can't tell you how many times I get the appraisal back and the appraiser appraises it exactly at the purchase price.
Right.
I don't know if this is, just a coincidence, but it seems like a lot of appraisers, put it this way, if you had 10 different appraisers going to appraise the house without a contract of sale stating how much they're buying it for, they might all come back with a different purchase, a different value of a number. So we like to have that seller's concession in there from the beginning. If the client wants to add a seller's concession after the appraisal comes back, well, the appraisal might come back exactly at the purchase price without the seller's concession, and then there's no wiggle room to wrap the closing costs in, because the bank isn't going to give you a loan for more than what the home is worth. The reason for this is because if you default on the loan, then the bank is now upside down. So that's the main reason for going out and appraising the home. The reason, why we like to see that concession in there is so, the appraiser might, see the objective that the buyer has. And by all means, I'm not stating that, these appraisals are steered in any way, but I just find it pretty funny that a lot of appraisals come back exactly at the purchase price that's in the contract. And another thing I kind of wanted to touch on is, for instance, if you went in, if you are purchasing a home for $3,000, for example, and the appraisal comes back at $309,000. Well, we have the option to do an addendum to the contract with Steve and add the seller's concession in after, because the home appraised for higher. We're able to add the seller's concession in, and now the client can even finance their closing costs after.
So, on two things. One, just going back to your comment, I've spoken to actual different appraisers about that same thing. Well, since 2008, now they're looked at a lot more rigorously, and no appraiser wants to have a property that goes into foreclosure and then find out that their appraisal is way off.
Yeah.
So I had the same experience on many files and I do give the same advice to the clients. If you want a seller's concession, put it in now, because it's very rare that a property will appraise more than the contract price if it is close to the true value.
Yeah.
And even when it's not close, I've had properties that recently were a very good deal, so to speak. Someone had an inside track and knew that the property was worth $100,000 more, and the appraisal maybe came in $10,000-15,000 more. It's insane but I think it's because of that. 2008. No one wants to put their foot out out there anymore.
I don't want to ruffle the feathers.
Yeah, exactly. Now, another thing you said that sometimes, although it's rare, if the property does appraise more, you can do the sales concession afterwards. I've had some banks that will not do that and will not entertain that.
Wow.
But you don't have a problem with that, you're saying?
I really don't.
Okay.
And I've done it many times, just because, I think it's important for buyers to not be completely strapped after closing. I think having reserves after closing, there's something to say about that. First off, a lot of people have to furnish their new homes. So I think it's important. Another thing that my, maybe more sophisticated clients are doing, who are, investing in the market and have investments elsewhere, is, with interest rates so low, they're actually, after the appraisal comes back, they're actually, while they may have been financing way less, they're actually maximizing their financing, because they can take that money that they would have stored away in the equity of the house and actually invest it elsewhere and make a greater return than what they're paying in interest, and borrowing that money. So they're keeping a lot of that money in their pocket and essentially maximizing their financing on their homes. So I thought that was a pretty interesting point.
And I guess I have one last point before we break. Something else that I was just thinking about here, and just trying to be creative and on solutions for clients. So we talked about lenders' credits, and you had mentioned sometimes you want reserves to furnish the home or make repairs. Maybe that home, it was the perfect home if it had an updated kitchen. Right, so something else you can do that when you're looking out there, because it's really hard, especially with limited supply, to find that perfect home. One thing you can do is you can do a rehab loan. I'm not sure, and we'll ask Kai in a second, if you can couple rehab loan with a lender's credit, but you can finance the remodeling of that kitchen with a rehab loan, and also still write off the remodel which you couldn't do with a Home Depot credit card on your taxes, unless it's investment property. But if it's your primary home, now you can take that increased mortgage and have a tax write-off based because you wanted a new kitchen. So Kai, going back to what I said, can you couple a lender's credit with a rehab loan?
Yeah, so doing a rehab loan, it's a very similar process, except there's a bid from a contractor that is added to your purchase price. You can couple a lender credit with the rehab, and this is very common as well because usually people who are doing a renovation loan, very often they refinance short after, just because the interest rates on a renovation loan are slightly higher, and then they can couple that with a lender credit, and this really helps the initial loan. But sometimes when you're adding this renovation cost to the home, a lot of the times, if you're doing it right especially, you're adding more value than what you're adding to the loan for the renovation. So it's a really good way, these renovation loans, for buyers to get rid of their mortgage insurance if they're putting the least amount of money down, is doing a renovation loan, adding value with renovation in places that add actually more value to the home than the cost that you're putting into it, and then refinancing after and getting rid of the mortgage insurance way sooner than if you just closed on a normal loan.
It's funny when you were saying that, I was just thinking to myself, that probably adds value and probably can help out with the mortgage insurance. That's exactly what you said. So there's so many creative things out there that you can do. By taking out that mortgage insurance away, you may have taken out the cost of doing that new kitchen just by putting it in the kitchen. It's almost like you're getting a kitchen for free because you don't have to pay that mortgage insurance.
Exactly. And, I think it's... there's a lot of information on ways to be creative, on the attorney side and the loan side. But, what Steve and I are here to do when we speak to our clients is to really fact find and see what your objective is. I'm not going to talk your ear off about a renovation loan with a lender credit if that's not really your objective. We can, if we're speaking about, owner occupying a multifamily from a rental perspective, well, that's just an example of a completely different conversation than a renovation loan. And we can really fact find and see what's going to fit your goals and where you see yourself in the future. Another thing I just really wanted to touch on when it comes to refinancing and purchasing, speaking of the future and future objections, is one important thing to know is, and sometimes it's a hard question for a lot of buyers to answer, but how long you might see yourself in this home for. The reason why I ask that is because if it's a home where you might only see yourself in for a few years, well, it might make more sense to choose a higher rate with a lender credit, because the money that you're saving in closing costs, it pays for itself, because your additional payment from a little bit of a higher rate doesn't cost so much if you're only there for 2 years, but what you might get back in a lender credit is more beneficial at the time. When my clients find their lifetime home that they can see themselves in forever, it's very common for the buyers to buy down the rate, which is the opposite of taking a lender credit. You can actually close on a lower rate for a little bit of a cost. So for example, if it costs you $1,000 to buy down the rate, and it saves you $100 a month, well, that'll pay for itself in 10 months. So if you can picture yourself in the home for at least 10 months, then that's a very good opportunity to buy down the rate. Then it would pay for itself. The investment would pay for itself. So I always like to give my clients these options, and really try to fact find and see what their long-term goals are for the home buying process, to see what really makes sense.
All right, well, Kai, thank you for coming. If you have questions for Kai or myself, our contact information is going to be the next slide. It'll be up for a few minutes. Just give us a call and we'll be glad to help. Thank you. Hope you're enjoying the videos that you've watched today. They're not meant to be a substitution for speaking with your legal professional, but just an educational tool. Thank you.